You know, I've spent more than 60 years in this investment business, and I've seen it all. I've watched markets soar to dizzying heights and crash to devastating lows. I've witnessed the birth of new financial instruments, the rise and fall of investment fads, and the endless parade of people promising to beat the market. And through it all, I've held on to one simple truth that has never let me down. The best investment strategy is often the simplest one. Let me tell you something that might surprise you. When I founded Vanguard in 1974 and launched the first index mutual fund in 1975, people thought I was crazy. They called it Bogle's folly. The investment establishment laughed at the idea that you couldn't beat the market, that trying to pick winning stocks or timing the market was a fool's errand. But I knew something they didn't want to admit. I knew that costs matter, that time is your friend, and that the market itself, if you just stay with it long enough, will deliver returns that can transform your financial life. Financial freedom isn't some distant dream reserved for the wealthy or the lucky. It's achievable for anyone willing to follow a disciplined, long-term approach to investing. And I want to share with you today the formula that has worked for millions of investors, including many who started with nothing more than a modest paycheck and a commitment to their future. First, let me tell you what financial freedom really means. It's not about becoming a millionaire, though that might happen along the way. It's not about driving fancy cars or living in a mansion. Financial freedom is about having enough money to live comfortably without worrying about every expense, about being able to retire with dignity, about having the resources to help your children or grandchildren, about not being dependent on others in your old age. It's about peace of mind. And that peace of mind comes from making smart decisions today that will pay off for decades to come. The foundation of my investment formula starts with one word: simplicity. The financial services industry has spent billions of dollars convincing you that investing is complicated, that you need sophisticated strategies, complex products, and expensive advisors to succeed. They want you to believe this because complexity is profitable for them, not for you. Every layer of complexity they add is another opportunity to charge you fees, and those fees are the silent killers of investment returns. Let me give you a number that should make your blood run cold. If you invest $10,000 in a fund that charges 2% in annual fees, and that fund earns 8% annually before fees, after 30 years you'll have about $43,000. But if you invest that same $10,000 in a fund that charges just 0.2% in fees, earning the same 8% return, you'll end up with about $74,000. That's a difference of $31,000, more than 3 times your initial investment lost to fees. And that's assuming the high-cost fund even matches the market return, which most don't. This brings me to the first principle of the long-term investment formula: minimize costs relentlessly. Every dollar you pay in fees is a dollar that can't compound and grow for you. It's a dollar taken from your family's future. When I created the first index fund, my goal was simple. I wanted to give ordinary investors access to the entire stock market at the lowest possible cost. No stock picking, no market timing, no pretense that we could outsmart millions of other investors. Just own the entire market and let capitalism work for you. The beauty of index investing is that it guarantees you'll capture your fair share of market returns. You won't beat the market, that's true. But here's the secret. The active fund managers don't want you to know. You don't need to beat the market to achieve financial freedom. The market's returns, compounded over time, are more than enough. The average annual return of the U.S. Stock market over the past century has been about 10%. Even accounting for inflation, that's roughly 7% in real returns. That means your money doubles in real purchasing power about every 10 years. Think about that for a moment. If you start investing at age 25 with $10,000 and add just $500 a month, earning 7% after inflation, by age 65 you'll have over $1.2 million in today's purchasing power. That's financial freedom, built dollar by dollar, month by month, year by year, without any magic, without any luck, without picking the next hot stock or timing the market perfectly. But here's where most people go wrong. They start investing, they see their account growing, and then the market drops. Fear takes over. They see their hard-earned savings declining in value, and they panic. They sell thinking they'll buy back in when things settle down. This is the second principle of the formula: stay the course. No matter what happens in the market, no matter how scary the headlines get, no matter how much your friends and neighbors are panicking, you must stay invested. I've lived through some of the most terrifying market crashes in history. The crash of 1987, when the market dropped 22% in a single day. The bursting of the tech bubble in 2000. The financial crisis of 2008, when it felt like the entire financial system might collapse. And you know what? Every single time, the market recovered. Every single time, patient investors who stayed the course were rewarded. Every single time, those who panicked and sold locked in their losses and missed the recovery. The market is volatile. That's not a bug, it's a feature. Volatility is the price we pay for the extraordinary long-term returns that stocks provide. If you can't handle seeing your account value fluctuate, if you can't sleep at night when the market drops 10 or 20%, then you probably have too much in stocks and need to adjust your asset allocation. But whatever allocation you choose, once you've set it, stick with it. This leads to the third principle: asset allocation. How you divide your money between stocks and bonds is one of the most important decisions you'll make. When you're young, you can afford to take more risk because you have time to recover from market downturns. A common rule of thumb is to subtract your age from 100 and invest that percentage in stocks with the rest in bonds. So if you're 30 years old, you might have 70% in stocks and 30% in bonds. As you age, you gradually shift more into bonds, which are less volatile but provide lower returns. But here's what's crucial. Whatever allocation you choose, keep it simple. You don't need 10 different stock funds covering different sectors or styles. You don't need emerging market funds, real estate funds, commodity funds, and all the other exotic options the financial industry wants to sell you. A simple portfolio of a total U.S. stock market index fund, a total international stock market index fund, and a total bond market index fund is all you need. 3 funds, that's it. You can achieve complete diversification and capture the returns of the global capital markets with just 3 low-cost index funds. Now let me talk about the fourth principle, and this one might be the most important of all. Invest regularly and automatically. The technical term for this is dollar cost averaging, but what it really means is that you invest the same amount of money at regular intervals regardless of what the market is doing. When you do this, you buy more shares when prices are low and fewer shares when prices are high. This takes emotion out of the equation and ensures you're always investing. The best way to do this is to set up automatic investments from your paycheck. If your employer offers a retirement plan like a 401k, contribute to it automatically with every paycheck. If you're self-employed, set up automatic transfers from your checking account to your investment account. Make it so you never see the money, never have to make the decision to invest it. It just happens, month after month, year after year. This is how wealth is built, not through brilliant stock picks or perfect market timing, but through the simple discipline of regular, consistent investing. And speaking of retirement accounts, let me emphasize the fifth principle: take full advantage of tax advantage accounts. If your employer offers a 401k match, contribute at least enough to get the full match. That's free money, an instant 100% return on your investment. Max out your 401k if you can, and if you can't, contribute as much as possible. The tax benefits are enormous. Traditional 401k contributions reduce your taxable income today, and the money grows tax deferred until retirement. Roth accounts let you pay taxes now but grow tax-free forever. Either way, you're getting a huge advantage over taxable accounts. After maxing out your retirement accounts, if you still have money to invest, you can put it in regular taxable accounts. But even there, index funds have an advantage because they generate fewer taxable distributions than actively managed funds. The tax efficiency of index funds is yet another reason they outperform the vast majority of actively managed funds over time. Now, let me address something that I know weighs on many people's minds. What about when I need the money? What if there's an emergency? What if the market crashes right when I'm about to retire? These are legitimate concerns, and they bring me to the sixth principle. Plan for the long term, but prepare for the short term. Before you invest a single dollar in the stock market, make sure you have an emergency fund. This should be 3 to 6 months of living expenses in a savings account or money market fund, something completely safe and liquid. This emergency fund is your buffer against life's uncertainties. It means you'll never be forced to sell your investments at the wrong time because you lost your job or had an unexpected medical expense. It gives you the freedom to stay invested for the long term because you know you can handle short-term emergencies. As you approach retirement, you should also build what I call a cash cushion, perhaps 2 to 3 years of living expenses in cash or short-term bonds. This way, if the market crashes right when you retire, you can live off your cash cushion while waiting for the market to recover, rather than being forced to sell stocks at depressed prices. This is one of the smartest moves a retiree can make, and it allows you to keep a significant portion of your portfolio in stocks, even in retirement, capturing the growth you'll need to fund a retirement that might last 30 years or more. The seventh principle is one that people often overlook: rebalance periodically. Remember that asset allocation we talked about? Over time, it will drift. If stocks perform well, you might end up with more in stocks than you intended. If bonds do well or stocks decline, you might have too much in bonds. Once or twice a year, check your allocation and rebalance back to your target. This forces you to sell high and buy low, exactly what you should be doing, and it maintains the risk level you've chosen. The beauty of index investing is that rebalancing is simple and cheap. You're not trying to pick which stocks or which sectors to overweight. You're just maintaining your chosen mix of stocks and bonds. This discipline helps protect you from the tendency to chase performance, to pile into whatever has done well recently, which is one of the surest ways to destroy wealth. Let me share the eighth principle. Ignore the noise. Turn off CNBC. Stop reading the financial news every day. Don't check your account balance constantly. All of this noise does nothing but tempt you to make emotional decisions that will hurt your long-term returns. The financial media exists to generate advertising revenue, and they do that by creating excitement and fear. Every day is either the best time to buy or the sky is falling. None of it matters to the long-term investor. I'm not saying you should be completely ignorant of what's happening in the world or the markets, but there's a big difference between being informed and being obsessed. Check your investments once a quarter or even just once or twice a year. Make sure you're still on track to meet your goals. Rebalance if needed, and then go live your life. Your time is better spent with your family, pursuing your hobbies, or advancing your career than it is staring at stock charts and reading market commentary. The ninth principle is about something deeper than investment strategy. It's about living below your means. All the investment wisdom in the world won't help you if you spend everything you earn. The path to financial freedom requires that you consistently spend less than you make and invest the difference. This doesn't mean you have to live like a miser, but it does mean making conscious choices about what truly matters to you. I've known people who earned modest salaries but retired wealthy because they lived modestly and invested consistently. I've also known people who earned high incomes but retired broke because they spent everything they made trying to impress others. The amount you earn matters less than you think. The amount you save and invest matters more than you can imagine. If you can save and invest 15 or 20% of your income throughout your working life, you will retire wealthy. It's that simple. The 10th principle is perhaps the most philosophical. Remember that enough is enough. Our consumer culture constantly tells us that we need more, that we'll be happy if we just have the next thing, the bigger house, the newer car, the latest gadget. But the research is clear: beyond a certain level of comfortable sufficiency, more money and more stuff don't make us happier. What makes us happy is meaningful relationships, purposeful work, and the sense of security that comes from knowing we'll be okay. Financial freedom isn't about accumulating the largest possible pile of money. It's about having enough to meet your needs and reasonable wants, to weather life's storms, and to leave something for the people and causes you care about. Once you understand this, once you truly internalize that enough is enough, you're freed from the endless treadmill of wanting more. You can focus on what really matters. Now, I know what some of you might be thinking. This all sounds fine, but what about the people who made fortunes picking the right stocks? What about Warren Buffett? What about all those stories of people who got rich quick in the stock market? Let me be clear, those stories are real, but they're also rare. For every person who got rich picking individual stocks, there are hundreds who lost money trying. For every successful day trader, there are thousands who blew up their accounts. Warren Buffett himself, one of the greatest investors who ever lived, has said repeatedly that most people should invest in low-cost index funds. In fact, in his will, he's instructed that the money he leaves to his wife should be invested 90% in an S&P 500 index fund and 10% in short-term government bonds. If that's good enough for Warren Buffett, it should be good enough for the rest of us. The financial services industry has spent decades creating the illusion that they can consistently beat the market, that they have some secret knowledge or superior ability that justifies their high fees. But the evidence is overwhelming. Over the long term, the vast majority of actively managed funds underperform simple index funds. After fees and expenses, perhaps only 5% of active managers beat the market over a 20-year period. And good luck figuring out in advance which 5% it will be. The winners constantly change. This brings me to an important truth. Investing is one of the few areas in life where trying harder and paying more actually gets you worse results. In most endeavors, if you want better outcomes, you work harder and spend more money on quality. But in investing, the harder you try to beat the market, the more you pay in fees and taxes, the worse your results are likely to be. The path to investment success is to do less, not more, to accept market returns rather than chase outperformance, to minimize costs rather than pay for expensive advice and trading. This doesn't mean you're being passive or lazy. It means you're being smart. You're accepting that markets are highly efficient, that the collective wisdom of millions of investors around the world is incorporated into prices, and that trying to outsmart all of them is a fool's errand. You're putting the odds in your favor by minimizing costs and maximizing the time your money is invested in compounding. Let me tell you about compounding, because it's the most powerful force in investing and one of the most important concepts you can understand. Albert Einstein supposedly called compound interest the eighth wonder of the world, and he was right. When your investments earn returns, those returns start earning returns of their own. Over time, this snowball effect creates wealth that can seem almost magical. Here's a simple example. If you invest $100 and earn 10%, you have $110 after a year. The next year, you earn 10% on $110, giving you $121. The year after that, you earn 10% on $121, and so on. The growth accelerates over time because you're earning returns on your previous returns. Now imagine doing this for 40 years with regular contributions. The growth becomes exponential. This is why starting early is so crucial. Every year you delay investing is a year of compounding you've lost forever. A 25-year-old who invests $5,000 a year for 40 years at 8% will have over $1.3 million at 65. A 35-year-old who invests the same amount for 30 years will have only about $566,000. That 10-year head start is worth more than doubling your final wealth, even though you only invested $50,000 more. This is why I tell young people, start now, no matter how small the amount. Even if you can only invest $50 or $100 a month, start today. The habits you build and the compounding you start now will transform your financial future. Don't wait until you're making more money, until you've paid off your credit cards, until you feel like you have enough. Start now with whatever you have. And for those of you who are older, thinking you've waited too long, let me tell you, it's never too late to start. You might not have 40 years of compounding ahead of you, but you might have 20 or 30 years of retirement. Your money still needs to grow to keep pace with inflation and fund what could be a very long retirement. The best time to start investing was 20 years ago. The second best time is today. One of the questions I'm often asked is about market valuations. Should you invest when the market seems expensive? Should you wait for a crash? Let me be blunt. You cannot time the market. Nobody can. Not consistently. I've seen the smartest people in the business try and fail. I've seen elaborate models and sophisticated strategies all come up empty. The market is too complex, too influenced by unpredictable events, too driven by human psychology to be timed with any consistency. Yes, there are times when the market seems expensive by historical standards and times when it seems cheap. But even if you can identify these periods correctly, which is harder than it sounds, you still can't predict the timing of when expensive markets will fall or cheap markets will rise. Expensive markets can stay expensive and get more expensive for years. Cheap markets can get cheaper before they recover. Waiting on the sidelines for the perfect moment means missing out on dividends, missing out on compounding, and potentially missing some of the best days in the market. Studies have shown that missing just the 10 best days in the market over a 30-year period can cut your returns almost in half. And those best days often come right after the worst days, when fear is highest and people are most tempted to sell or stay out of the market. The only way to capture those best days is to always be invested, to stay the course through thick and thin. I want to talk about something that doesn't get enough attention, the emotional side of investing. The investment formula I've laid out for you is simple, but simple doesn't mean easy. The hardest part of successful investing isn't understanding the strategy. It's having the discipline and emotional fortitude to stick with it when every fiber of your being is telling you to do something else. When the market crashes and you see your life savings cut in half, your instinct is to sell to stop the bleeding. When your neighbor tells you about the hot stock that's made him 50% in 6 months, your instinct is to jump in and chase that return. When you see negative headlines about the economy every single day, your instinct is to get out of the market and wait for things to improve. All of these instincts are wrong. All of them will hurt your long-term returns. Successful investing requires you to act contrary to your instincts. It requires you to be greedy when others are fearful and fearful when others are greedy, as Warren Buffett says. It requires you to do nothing when everything in you wants to do something. This is why having a plan and sticking to it is so crucial. When emotions run high, you can fall back on your plan. You can remind yourself that you've thought through these scenarios, that you've decided in advance how you'll handle them, and that the right move is to stay the course. This is also why simplicity matters so much. A simple portfolio of index funds is easier to stick with than a complex portfolio of actively managed funds and individual stocks. When everything you own is going down, you're more likely to panic. But when you own the entire market through index funds, you can remind yourself that you own America's businesses, that over time these businesses will innovate and grow and create value, and that your patience will be rewarded. Let me share something personal. I've been investing for over 60 years, and I've made my share of mistakes. Early in my career, I thought I could pick winning mutual funds. I thought I could identify talented managers who would beat the market. But over time, I learned that past performance doesn't predict future results, that talented managers retire or lose their touch, and that even if you could identify the best managers, their high fees would eat up much of any outperformance. These lessons led me to create Vanguard and the index fund. It wasn't because I gave up on trying to beat the market. It was because I realized that for most investors, trying to beat the market was counterproductive. It led to higher costs, more emotional decision-making, and worse results. The humble index fund, boring as it might seem, was actually the most powerful tool I could give to ordinary investors. When I look back on my career, I'm most proud not of the wealth Vanguard has accumulated or the size it has grown to, but of the wealth we've helped millions of ordinary people build. I'm proud of the retirees who can live with dignity because they invested in index funds. I'm proud of the families who could afford to send their kids to college because they saved consistently in low-cost funds. I'm proud of the financial freedom that so many people have achieved by following the simple principles I've shared with you today. Financial freedom is within your reach. It doesn't require genius, luck, or special knowledge. It requires only discipline, patience, and the willingness to follow a proven formula. Invest regularly in low-cost index funds, minimize costs and taxes, diversify broadly, rebalance periodically, stay the course through market ups and downs. Live below your means, start early, and let compounding work its magic. It's not complicated, but it works. The world will try to distract you from this simple truth. You'll be bombarded with investment products, hot tips, and sophisticated strategies that promise better returns. You'll be tempted to try to beat the market, to chase performance, to time your investments. Resist these temptations. Remember that in investing, boring is beautiful, simple is powerful, low cost is high value. I've often said that investing is not about getting rich quick. It's about getting wealthy slowly but surely. It's about making prudent decisions today that your future self will thank you for. It's about understanding that time is your greatest asset as an investor, and that the real secret to investment success is simply to start early, invest regularly, keep costs low, and never give up. As I near the end of my time, I look at the legacy I'm leaving, and I'm confident that the principles I've championed will continue to serve investors well long after I'm gone. The laws of arithmetic don't change. Costs matter. Time is your friend. Diversification reduces risk. Staying the course works. These truths are eternal. My final piece of advice is this: don't let perfect be the enemy of good. You might not be able to max out your retirement accounts. You might not be able to save 20% of your income. You might start later than you should have. None of that matters as much as starting now and doing what you can. Every dollar you invest today is a dollar that can grow and compound and contribute to your financial freedom. Every month you invest consistently is a month you're building wealth and securing your future. Financial freedom is a journey, not a destination. It's built day by day, dollar by dollar, decision by decision. There will be setbacks and market crashes and moments of doubt. But if you stay focused on the long term, if you maintain your discipline, if you keep costs low and stay invested, you will get there. The formula works. It has worked for millions of people, and it will work for you. The beautiful thing about this approach to investing is that once you have it set up, it requires very little ongoing effort. You're not spending your time researching stocks or timing the market. You're not worrying about every market move or financial headline. You've built a simple, low-cost portfolio. You're investing automatically, and you're getting on with your life. This is how investing should be: a means to an end, not an end in itself. Your life is meant to be lived, not spent obsessing over your portfolio. The investment formula I've shared gives you the financial security to pursue what really matters to you, whether that's your career, your family, your hobbies, or your contributions to your community. It gives you freedom, true freedom, to make choices based on what you want rather than what you can afford. So start today. Open an account if you haven't already. Set up automatic investments. Choose a simple portfolio of low-cost index funds. Make a commitment to yourself and your future. And then trust the process. Trust that markets reward patient investors. Trust that costs matter and that time is on your side. Trust that you don't need to be brilliant or lucky to achieve financial freedom. You just need to be disciplined and persistent. This is my gift to you, the culmination of a lifetime spent in the investment business. It's a formula that works, a path that leads to financial freedom, and a philosophy that has served millions of investors well. It's yours to use, and I hope you'll embrace it and benefit from it for the rest of your life. The power to build wealth is in your hands. Use it wisely, invest for the long term, and never, ever give up on your financial future. Thank you, and may your investments prosper.